Thanks for starting your week with us. Hello and welcome to Business Daily. I'm Lee Ji-yoon in Seoul. We have a lot on our plate today, so let's get started with the day's highlights. With this month's monetary policy meeting coming up, all eyes are on what move the central bank will make to get the Korean economy back on its feet. One Korean drug company takes a step closer to winning approval for its biosimilar drug to treat arthritis in the U.S. But first, we've been seeing the trend of sliding exports here in Korea continue into this month, and figures tallied up so far indicate that the country is poised for yet another decline in outbound shipments. Our Park Ji-won starts us off.
The Korea Customs Service says Korea's export volume during the first 10 days of this month posted about $8.7 billion, which is nearly a 30% drop from the same period last year. That's only a record from the first 10 days of this month, so it's too early to predict the final export figure for February. However, if this trend continues, February could see another on-year decline in export volume. This will mean exports have fallen for the 14th straight month since January last year, the longest ever period of decline since figures were first recorded in 1970. Analysts say one of the biggest culprits for the decline are falling global oil prices. Korea's exports in the petrochemical industry saw a double-digit decline last month. Korea's outbound shipments to Middle Eastern oil-producing countries also marked over 30% on-year decrease last month. A slowdown in China, Korea's biggest trade partner, also negatively affected Korea's exports, as Korea's outbound shipments to China in January posted about a 20% on-year decrease. Given the circumstances, the Korean government aims to lessen export dependency on China and diversify by exploring new markets like Iran and Cuba. The government is also planning to announce a whole new set of measures sometime next month to increase exports in the consumer goods industry and decrease dependency on the heavy and petrochemical industry. Park Ji-won, Business Daily.
The Bank of Korea will set the key interest rate for this month tomorrow. Eyes are on whether the central bank will make a move and cut its 1.5% rate to speed up momentum when it faces no shortage of other issues to juggle. Our Hwang Jae has the details.
A tough decision awaits Korea's central bank as it gears up for February's monetary policy meeting scheduled for Tuesday. With a worsening slump in exports coupled with tepid domestic demand, the Bank of Korea has been facing growing calls to tackle such issues by lowering its key rate. What has further fueled this sentiment is Japan's central bank, which not so long ago joined the negative rates club. The concern is this will chip away at Korea's price competitiveness against its export rivals.
If it's only the Korean won that's appreciating, the trend could devastate local exports. So to adjust the exchange rate, the central bank should pump money into the economy by cutting the key rate.
A recent sign from Federal Reserve Chair Janet Yellen indicating that the U.S. might delay further raising rates also gives Korea more room to trim its own rate. On the back of the Fed's earlier projection for 4 rate hikes this year, dark clouds had hovered above Korea over the possibility of a massive capital outflow. But economists say going even lower on the key rate that already stands at a record low cannot be a cure-all.
The main cause of companies not investing and households not spending is not because the key rate is too high, but because they're not optimistic about future opportunities for profitability.
In fact, amid slowing global demand, Japan's aggressive monetary easing has not yet produced the results the government had hoped for, with the yen sharply strengthening and local shares tumbling. The Bank of Korea also has its hands full with snowballing household debt that stands at a heavy $1 trillion. Facing such mixed circumstances, the market consensus about this month's rate meeting is that monetary policymakers will stay put on the current 1.5%. But if we expand the timeline to the first half of this year, there are still expectations for an additional rate cut. Hwang Jie, Business Daily.
And for more on last week and this week's stock market action, we have our markets reporter Choi Jin-seok from SBS CNBC joining us on the phone today. Hello, Jin-seok.
Thanks for having me, June.
All right, let's get started by looking at the Korean stock market. Tell us about Friday's close and its overall performance last week.
Yes, the Kospi plunged by more than 1.4% to close at 1835 on Friday. Despite massive stock buying by institutional investors, both retail and foreign investors dumped shares, eventually dragging down the index. The tech-weighted Kospi market took the biggest hit last week. The index fell by more than 6% to close at just above its 600 level. A circuit breaker, which an automatically operated electrical switch designed to curb panic selling moves, was triggered for the first time in 4.5 years. On a weekly basis, the Kospi fell by 4.3%, even though there were only 2 sessions last week due to the Lunar New Year holiday.
All right, then. How did the Korean stock market do on the first day of this week?
Yes, the Korean stock market joined the upward trend set up from both European and U.S. stock markets at the end of last week. The Kospi briefly rose as high as 1864 at one point, while the Kosdaq enjoyed more than 2% of gains. Institutional investors continued to buy large amounts of shares today, but other investors still sold shares. The Kosdaq, which was battered hard last Friday, succeeded in rebounding, largely helped by individual investors who bought around 60 billion Korean won or $50 million worth of stock on a single day.
Now, Asian markets have been in the spotlight lately. Do you expect this trend to continue this week?
I would say so. First of all, investors are expected to keep their eyes on the Japanese stock market this week. The country's benchmark Nikkei 225 plummeted by more than 11% last week, spooking investor sentiment worldwide. About 2 weeks ago, the Bank of Japan, or the BOJ, unexpectedly rolled out a negative rate policy for the first time in its history. The BOJ's aim was to revive the country's economy by boosting lending activities and depreciating its currency value. But excessively low interest rate policies worldwide spurred concerns of global banks' profitability, leading to a massive stock sell-off worldwide. Furthermore, market jitters and heightened volatility have led to capital inflows to safe assets such as gold and the Japanese yen. This is why the Japanese stock market, which moves inversely with the yen, took the biggest hit. The Nikkei surged by over 7% today, giving a sigh of relief to the investors. But we should brace for sudden changes in this trend at any given time. The Chinese stock market will also be under scrutiny. The Shanghai market reopened today after a one-week holiday. While the market had been closed, global market fears had heightened as well. This is why many investors have been worried that the Shanghai market would provide cause for greater concern. The index began the session with about a 2.5% decline, but has been trimming its losses during the session, giving some relief to investors.
And as we heard earlier, the Bank of Korea is holding its policy meeting tomorrow, and there are greater calls for a rate cut, but there are also concerns that this would cause more trouble. Now, where do experts stand on this?
Actually, the majority of market experts expect the BOK will keep its benchmark interest rate for 8 consecutive months. 19 out of 24 economists surveyed by Bloomberg predict it will not go any lower on rates throughout this quarter, actually. But we can't rule out the possibility that the BOK will pull the trigger to boost the economy. Of all things, unexpectedly disappointing export figures in January may affect the central bank's stance, which has reiterated that it will closely monitor economic indicators rather than inflation. Korea's markets are reflecting stronger possibilities of an imminent rate cut after Japan added to its unprecedented stimulus and the U.S. signaled a delay in monetary tightening. For example, the yield on 3-year sovereign debt recently dropped below the BOK's policy rate of 1.5%. One other thing that will be interesting to note is if there are any dissent among BOK officials this month, even if the bank decides to hold. This has been Choi Jin-seok from SBS CNBC.
Over the next 5 years, the market for biosimilars, or copies of original pharmaceutical drugs, is projected to top $40 billion. And one Korean drug company is poised to make headway into the U.S. market with the drug to treat arthritis. Our Lee Ju-young has more.
April 6 may be the decisive day that a Korea-based maker of biosimilar drugs, or lower-cost copies of brand-name biologic drugs, breaks into the U.S. market for the first time. On that day, the U.S. Food and Drug Administration will either approve or reject Сел트리온's flagship medicine, 램시마. It's the low-cost version of Johnson & Johnson's Remicade, the world's third best-selling arthritis treatment drug, which logged almost $10 billion in global sales in 2014. Although Сел트리온 has not yet disclosed what it would charge for 램시마, prices are projected to be about 40% cheaper than the Johnson & Johnson's original. And if 램시마 receives the green light, experts say the drug may be able to nab a significant portion of the antibody drug market in the U.S., worth roughly $4.5 billion. Market watchers say approval is highly likely, with a medical advisory panel to the FDA recommending a go-ahead for 램시마 last week. The panel determined that clinical trials showed the drug having almost the same effect as that of its original Remicade. 램시마 has already been approved by the European Medicines Agency and is being used in 67 countries around the world. Lee Ju-young, Business Daily.
Convenience stores here in Korea posted strong sales growth in 2015, but other retailers struggle to overcome sluggish domestic consumption. Statistics Korea says sales at convenience stores jumped nearly 30% on year to $13.6 billion last year. The sales boost came from the popularity of ready-made meals and increased margins from a hike in cigarette taxes. Sales at department stores, however, slid 0.4% on year to $24 billion, marking 2 straight years of decline. Performance in June was particularly poor, with department stores suffering a 12% drop compared to the previous year following the Middle East respiratory syndrome outbreak. They saw some relief in October with the help of government-backed sales events. The combined sales of brick-and-mortar stores here in Korea inched up 3.4% from a year earlier to nearly $230 billion. 2 consortiums are set to launch Korea's first internet-only banks this year. That's KakaoBank and K-Bank. And it looks like they're getting ready to jump into the credit card market as well. So what's their strategy to luring customers? Our Eunice Kim takes a look.
After clenching the government's green light in November, KakaoBank is now looking to the credit card market. In a bid to encourage innovation in Korea's stagnant financial services sector, bogged down by historically low interest rates and subdued business sentiment, its top regulator is lowering the bar for internet-only banks to enter the credit card business. Until now, rules had required a company have at least 300 workers and 30 member stores to qualify. But the Financial Services Commission has lifted this prerequisite for internet-only banks. To expand its business, KakaoBank's strategy is to lower fees and offer more points than their brick-and-mortar counterparts. By eliminating the need for a separate payment processing agency, it plans to scrap the fee that amounts to about 2% of any given transaction. Also, it plans to reduce the fees that credit card companies typically collect from their member stores, handing back what amounts to a 1% savings to both vendor and customer. And customers can receive more credit if they choose to accept a refund in internet shopping mall points over cash. K-Bank, the consortium led by KB Kookmin, is also said to be prepping a credit card market entry. It's a sector that has been losing steam, shedding more than 10,000 customers in the first half of last year, according to the Financial Supervisory Service data. Will the changes in store be a better fit for tech-savvy users? Those who are optimistic say a remarkable shift is on the horizon for the domestic credit card market. Eunice Kim, Business Daily.
And that wraps it up for today. But we'll be back tomorrow at the same time, same place for your Business Daily. So don't forget to tune in then. Thanks for watching and have a great day.